If you've done a good job in saving for retirement, congratulations. But where do most people save for retirement that have been successful? And overwhelmingly, it is in employer-sponsored retirement accounts, such as a 401k. So now, depending on the type of employer, you may have a different name, right? It may be called a 403b, a TSP, a 457, or some other name. While there's different names and there are some differences, they have a lot in common. A lot of the incentives are in common. But you really do have a tax problem, and it's because it was designed that way. And you are most likely going to be paying far more tax in retirement than you expected. And so I want to show you here on the board just to show you the concept and how you can minimize taxes going forward. Okay, so if you have a 401k, it's ultimately going to become an IRA if it hasn't already. But as you're putting money in through your payroll deductions, it's automatic. Once you set that up, it's great because it's out of mind, out of sight. You just automatically saving, right? That's a powerful concept. And then most companies have an added incentive of a company match. Some percentage, you put in your money, they match it up to a certain percent, which is amazing because that's 100% return on whatever that percentage is. And so you really want to take advantage of that. And if you've been successful, you probably did. So now, when you put money in, as well as the employer, as well as the gains over 20 or 30 years that it's been invested, that has grown to a nice sizable account balance, right? All tax deferred. So when you put the money in, you got a tax deduction. You did not pay the tax on that money. The gains tax deferred. Everything's tax deferred, tax deferred. Deferred until when? Or postponed until when? Until retirement, right? So these accounts have a forced distribution built into them, right? It's called an RMD, required minimum distribution. And so at some point in time, if you don't start taking income out, they're going to force you to take it out. And at what age? So for some of you, you may have started RMDs at age 70 and a half. Some of you at age 72. Most nowadays it's going to be age 73 or 75, depending on your date of birth. Okay. Now the IRS has a very special word that they use to describe money that is coming out of one of these accounts. And it's called ordinary income. And how much of that money is going to be going to taxes? Well, it depends on, first, our marginal tax system, right? So the larger your balance, the larger your income will be. It's designed that way, right? And so the more you have, the more you will end up paying in taxes. And so now you may have thought, as many people have thought or anticipated, that while they're working in their earning years, they're getting that tax deduction, and then later in retirement, their income would be lower, their taxes would be lower. But the reality is that's really not the case for most people. The other factor here is that tax rates are likely to be higher for a lot of reasons. But even if they weren't, you're still going to be paying more taxes than you think. And then there's that risk of taxes even being higher. Because what tax rate do you pay? It's whatever the tax rates happen to be in the years in which you take distributions. And so it's a variable. It's an unknown. And so there's what we call tax rate risk. Okay. Now, this is just income, right? But what about capital gains? Do capital gains, are they taxable? Capital gains are taxable, right? And so there are three tax brackets. There's a 0, 15, and the largest is 20%, okay? So what how do we determine what tax bracket our capital gains will be in? It's tied back to the income. So wherever we are here, it's going to affect and push up taxes here, okay? But that's not all. All right, what about Social Security? There's 3 brackets there, right? You have 0, and you have 50%, and you have 85% of your Social Security benefits in retirement that are taxable. Well, what determines how much of your Social Security benefits will be taxed? It comes back to the income. You see, there's a pattern here. The IRS is playing chess, and if you don't realize that you're playing chess, then you're probably losing the game. Now, but this is not all, right? What about Medicare? Does everybody pay the same on Medicare? No. What determines how much you pay, and if you pay the IRMAA surcharges? It's back to the income again, right? What is your income? It's going to cause these other taxes to kick in. We call them tax triggers. So let me give you an example. We have a client we're working with. In 2024, their effective tax rate is 12%. And they're in a situation where, and I'm going to change the color here, they may want to consider a Roth conversion or Roth conversions over multiple years. And so now, why would you want to do a Roth conversion? If you convert some money from your tax-deferred account to a Roth, you are causing some taxation, right? You're going to have to pay some tax. But when it's done with some strategy, they can pay the taxes in those lower brackets and systematically take advantage of the taxes that are going to be paid, and they're going to get higher going forward. But if we do some Roth conversions, we get some of that money shifted into a tax-free account. And so not only is the money in the Roth now tax-free, all the gains are tax-free. There are some rules. You have to have an IRA at least 5 years. But when the money comes out in retirement, is that money taxed? No, it's completely tax-free. And not only is it tax-free, what did it do to this account? It made your RMDs smaller. And so you can continue to get the RMDs down, and get the tax-free growth if you have a systematic plan going forward. So we pull money out of a Roth IRA. Does it fall into the tax brackets? No, it does not. There's no tax. Does it cause our Medicare premiums to go up? No, it does not. How about Social Security? It does not. Now, Social Security alone, it's one thing to say, let's say that you can save, say, 10% on average over time in taxes. And then you string that over retirement, 10 years, 15 years, 20 years, 30 years. It's a huge amount, right? We're talking hundreds of thousands, if not millions, of tax savings over that time frame. And so being tax efficient really does make a big difference. Money coming out of the Roth, is it going to bump up and cause more taxation on capital gains? No, it's not. And so the Roth, it really is kind of the holy grail. The strategies have to be done methodically, and they're typically going to be multi-year. Now, let's fast forward a little bit. Let's say that you pass and you still have some money left in your retirement account. Are your beneficiaries, this is going to go to beneficiaries, right? Well, let me change the color back. Okay, so you've got beneficiaries that are going to receive whatever you have left. And the taxation for them is significantly worse. So whatever you are going to be required to pay in taxes, for these guys, it's going to be 3 to 4 times more in taxes. It's a significant tax loss. So now, the way it used to be in the past was we could do what's called a stretch IRA and stretch the required distributions over their lifetime. That's been done away with, and Congress has reduced the time frame to how many years? 10 years. So after 10 years, that account has to be completely emptied. And where does that go in their tax brackets? He goes on top of whatever their earnings are, whatever their income is. And if we're talking about your children, then they're going to be paying taxes on whatever they inherit at the higher tax brackets down the road. So it is very much, we can see the intent of Congress to create more revenue for the Treasury, and there's more of your money that is lost to taxes. Now, it can be improved. There's a lot of strategies. There's a lot of things that can be done where that's all legal, right? The tax code has a lot of incentives, and you can position things strategically to put yourself in a better situation. When you have money long-term in a tax-deferred account, you have compound taxes, taxes upon taxes, forever. They're never going to not be there. But when you get some of that money shifted into Roth, you've truly gotten out of that cycle. It creates a lot more certainty and predictability, tax-free growth going forward. Now, we have a lady who is a client. She has $1 million in her IRA. And she says, Lane, I really don't need this money. She has other sources of income. She has some rental properties. And she says, I really just want to pass it on to my son. It's there if I, really needed it until then, but ultimately I'm expecting to not use that for to go on my son. And so now if she was to pass on $1 million IRA, how much of that would her son actually get? It's a lot less than $1 million, right? Just estimating, let's say 600, using some round numbers here. But whatever it is, there's a significant chunk that would be lost to taxes. Now, here, this is just one strategy, and I'm not making any recommendations. These videos are always just educational in nature, right? Because I don't know enough about you. Financial advice is done one-on-one when we have your information. But so she's taking RMDs, and she doesn't really need those RMDs. So one strategy here to kind of solve this issue would be funding a life insurance policy. Now, she doesn't need life insurance from a risk standpoint. For her, it's really a tax strategy, right? So if her RMDs were used to fund a policy, and we'll say it's a $1 million life insurance policy, why would we even think about that? What are the tax consequences at her death? That'd be $1 million tax-free to her beneficiary, whoever she designated. And so now we've more than doubled how much, the inheritance with just a little bit of tax planning, going from this to about 1.6 million instead. So there are other things, right? Now, if you're charitably inclined, if you contribute on a regular basis to a charity or a church, you could consider QCDs, qualified charitable distributions. You really don't want to use after-tax dollars to make charities when you've got some qualified funds. There are some rules around that, and I'm just keeping it high level here. If you had highly appreciated assets, or in different circumstances, you may be interested in a donor advised fund, which can also provide some tax incentives and savings. But there are other tax triggers that I've listed here. But the key thing here to understand is that if you just accept the default and just let it roll the way it's traditionally done, you're going to pay more in tax, and significantly, because we think tax rates are never going to be as low as they are today, especially with the national debt and deficits and problems that we have. The pressure for taxes to be higher is significant, and there's an opportunity with good tax planning to preserve more of your money. And when you, like I say, over 10 years, 15 years, 20 years, 30 years in retirement, it's a significant amount of money that you keep for yourself and your family just because you were proactive. We call it proactive tax planning. It's not customary. It's not normal. Most accountants and other tax professionals, they're almost always looking at the current year. And they're looking for any way to save you taxes in the current year. They're not looking out over your retirement. And so that's the key difference between proactive tax planning versus traditional planning. So I hope you found something in this beneficial. It's just educational. My firm, we have a team of financial professionals. We are financial planners and we love to do retirement planning. We have a process. We call it the 5W Retirement Blueprint. It's a very specific process. We cover all the key issues to create a holistic retirement plan that is more stable and preserves more of your money going forward. If you have interest in a consultation on that, it's a free consultation. You can visit our website, martinsenwealth.com. You can also visit us at financialfastlane.com. But in any case, I hope you found this valuable. I look forward to seeing you in the next episode of the Financial Fast Lane.